This panel is styled the Peter G. Peterson Distinguished Lecture on Fiscal Responsibility and the Global Economic Outlook. We were very sorry to lose Pete this past year. He was a great supporter of the FPA, and we have an annual lecture in his honor. We will be in the very able hands of Robyn Meredith, who is the author of a remarkable book entitled The Elephant and the Dragon, The Rise of India and China and What It Means for All of Us. Robyn, the floor is yours.
We're going to be talking today about the global economic outlook, and we're going to put that in the context of fiscal responsibility. But before we start, I just want to remark on one thing. This is the first panel I have ever been on, and I've been on a lot, that is all women. And this year is the 100th anniversary of women getting the right to vote. And I really want to congratulate the Foreign Policy Association for having a non-manel, quite the opposite. It's impressive. So thank you very much. Each of us on the panel are going to summarize our views, and then we'll have a group discussion on stage. And then I'll throw it open to audience questions in the last 15 minutes. So counting on all of you to contribute your questions then. First, I just want to set the stage. The global economy is in reasonably good shape, as you know. Most economists are not forecasting a recession next year. About a third of economists in a recent Wall Street Journal poll believe we're going to have a recession in the next 12 months. Obviously, that means two-thirds do not. But global growth is slowing. So in the U.S., GDP is expected to grow about 2.1% this year, down from 3% last year. In China, the official GDP stands at 6.1%, which sounds really high by our standards, but for China is quite slow and slowing. And Goldman Sachs sees it coming in at between 5 and 5.5% this year, as the official GDP growth numbers in China are frequently overstated. Chinese government has been responding with stimulus to try to counteract that. In India, the economy grew at just 5%. I say just 5% in the latest quarter because that's the slowest growth in 6 years. So quite a slowdown. And last Friday, the Indian government announced a massive corporate tax cut, $20 billion, that along with other stimulus measures is likely to cause India to blow past its fiscal deficit target of about 3.3% GDP. The Indian government says, by the way, that with this and other stimulus programs, that it's trying to get to 8% GDP growth, but most economists say that that's a pipe dream. It's a little bit like the stimulus we put on in the U.S. that hasn't led to the growth that was expected. Meanwhile, in Europe, the European Central Bank sees a more protracted slowdown than it had expected. So I think this is important because at a time that the global economy is slowing, we're also seeing unprecedented uncertainty. And that's really weighing on both business sentiment and investing sentiment. And just as a reminder, because the world seems to be moving so much faster these days than it used to, yesterday we had an announcement of an impeachment inquiry for the U.S. president. 10 days ago, we had a massive oil shock, about half of Saudi Arabia's oil production capability taken off. Meanwhile, Brexit seems like every day there's a new headline. Nobody knows what's going to happen with that. And that's making it really hard to forecast growth, not only in the UK, but in the Eurozone. And of course, a bunch of this unpredictability is coming because of uncertainty about trade. Just as a reminder, if we think about the post-war system and post-war economic system, we now have the highest tariffs worldwide in 4 decades. So it's a substantial change. And a number of politicians around the world seem to be seriously contemplating the end of the globalization era. I mean, just yesterday, President Trump, addressing the United Nations, said, "The future does not belong to globalists." I think it's really, really important that that sentiment change, and he's not the only one. But let me just start by talking about U.S.-China trade, source of one of the major pieces of uncertainty. The trade war is 446 days old today. It seems hard to believe it's continued for more than a year, but that's when the U.S. first put on tariffs. The measurable impacts are not yet totally devastating, but I want to highlight 3 reasons that it's really, really problematic. First, the trade war adds to the uncertainty that we already have. There's a psychological impact for investors and for companies making spending decisions of just not knowing what the rules of the road are, what tariffs will be paid. Second, I think it's really important to understand that we are undercounting the cost of this trade war. And I'll explain what I mean. It's very, very hard to measure in terms of dollars and cents the full impact of it. And I'll just take the U.S.-China piece as an example. You know, at this morning's panel of Wall Street economists, we heard that their estimates are that about 0.3% has been knocked off of U.S. GDP growth because of the China trade war so far, the tariffs that we have so far, and we've got additional tariffs scheduled to come on. If they do come on, we may see a hit to GDP of about 0.6%, which when the U.S. is only growing at 2.1 is a pretty big deal. They also say it's very difficult to measure the cost of the uncertainty that the trade war has. I buy both of those things, but I think the other piece that we haven't yet talked about is the massive supply chain changes that are happening because of the trade war. And those are long-term. They're very difficult to measure. You know, I think the reason it's hard to, I think the reason that we're all undercounting the cost of the trade war is that, you know, nothing nefarious, but Wall Street economists are trying to measure the impact for investors. What is this doing to company earnings today that will affect the stock price, you know, this afternoon? And that the effect of the cost of the trade war has been masked in part by the stimulus we've had, the Trump tax cuts and other things. But this rerouting of supply chains that many companies have begun to embark on is a really long-term, very, very expensive cost. It will take down efficiency for many companies, and it is very difficult to measure in day-to-day movements of stock prices. The factory to the world that China had become is now being spread out to Vietnam and Bangladesh and Taiwan and Korea and the U.S. and Mexico and Canada, and the cost to companies to that for doing that is really huge. So there's a disconnect. What I'm saying is there's a disconnect between how the stock market views the cost of the trade wars, and therefore most of the commentators we hear about talking about the cost of the trade wars, and the actual cost that real businesses which are making things are experiencing, and that will have a much bigger flow-through effect on jobs and on the economy in the long term. But it's very, very difficult to measure because corporate America just sort of doesn't have the voices that we have, that we see. And then I want to bring up one other point about China trade war before we're going to other panelists, and that is that we're used to hearing about the U.S.-China trade war from the American perspective. There are a lot of slogans that are easy to grasp. China's unfair. China cheats on intellectual property. There's forced technology transfer. Those things are actually true. However, if I could ask you just for a second to look at it from China's perspective, I think that will help everyone see why it's so intractable, this trade war. From China's perspective, it's had the same economic policy now for 4 decades. China has not actually changed. It is an authoritarian capitalist system. Whether you like it or not, that's what it is. It works in terms of 5-year plans. That has served China very well. Unless you are one of the million Uyghur Muslims who is now in a gulag, or you're a human rights lawyer or a journalist, China has lifted hundreds of millions of people out of poverty quite efficiently using the very system that it currently employs. Western companies didn't like technology transfer, didn't like some of the policies that China has insisted on. However, for the companies, they made a calculation that the trade-off of getting access to the Chinese market or getting access to cheap Chinese production that they can export back into the U.S. was worth it. So from China's perspective, the U.S. is suddenly changing the game and making a lot of new demands that we did not make in the past. And it's important because it feeds into China's historical sensibility of being a victim of foreign powers. Those of you who are in the audience and are China historians will understand the depth of that feeling for Chinese. And so the way that we have presented the trade war in the U.S. has caused a backlash in China that is not very helpful to solving the issues that we are trying to solve. It has made Chinese, both government officials and everyday business people there, defiant. It has brought up historical feelings of victimhood and has really made it difficult to solve this problem. And once again, from China's perspective, they are trying to do something really hard, lift the rest of their people out of poverty and by having economic growth, and get past the middle income trap that afflicts so many countries at around the level of economic growth that they have. And this, let me give you a couple of examples of how that is impacting things in the trade war. How is China reacting on the ground? First, if you're a Chinese company and you produce goods for export markets in the U.S. and Europe, as you probably do, you have now changed as much as possible of your supply chain to buy from non-American sources. So if you put Intel chips in your products, you are looking for Korean or Japanese or Taiwanese manufacturers to replace them as fast as possible. Multiply that to everything that is made in China, which is frequently, there are many components in any good that's exported from China. All of those Chinese buyers are moving as fast as possible away from U.S.-sourced goods to other countries. And the second thing is, one of the big complaints in the China that the U.S. has in the China trade war is the China 2025 program, which is the idea that China wants to upgrade its technology by 2025 to be equal to or even surpass U.S. technology, which it's now behind. From the people I talk to, this feeling of nationalism and anger at the way the trade war has been prosecuted has led them to say, we're not doing China 2025, now it's China 2021. And so it's really accelerated the determination of Chinese to be self-sufficient or to surpass the West in capabilities. And that just makes the trade war much more intractable. But enough about me. I could go on about China for quite some time, and happy to take questions in the Q&A. But I also want to move to all the rest of the things that are happening in the world. And let me, with that, introduce Ceyla Pazarbasioglu. She's at the World Bank. She's going to focus on the challenges for especially fiscal responsibility in emerging economies. So, Ceyla.
Thank you very much. It's a pleasure to be here. I would like to move the focus to the broader, what we call emerging markets and developing economies, and put this in the context of slowing down of global growth and what that means for those countries. And in particular, at the bank, our twin goals, our main mandate is eliminating extreme poverty and increasing shared prosperity. And the global slowdown in growth, and especially the slowdown in investment, has huge implications, not only for the developed world, but also for many of these countries. The poverty reduction, we have made a lot of progress. I don't want to cite a lot of numbers, but we have made a lot of progress in the last 20 years. What we now have is poverty concentrated much more so in sub-Saharan Africa. And in the next 10 years, it's going to be almost 85–90% concentrated in those countries. And that poses a lot of difficulties and concerns in very populated countries with aspirations, and therefore triggering a lot of issues related to migration, related to changes in terms of economic empowerment in many of those countries. The poverty is not only concentrated in sub-Saharan Africa, but also in people living in rural sector, as well as in the FCV context, fragile and conflict states, which again has its own implications for those countries, as well as spillovers to the rest of the world. We talked about infrastructure gap 2-3 years ago, trillions, you need trillions of infrastructure, not only in the developed world, but also in most of the developing world. And last year we came up, last annual meetings, with the human capital gap. And the numbers are really worrisome and concerning, where you have in certain countries 70% of 10-year-olds cannot read or write. So it's really a major problem. Why? How does that relate to growth? Because with growth, and especially when we have growth, economic transformation and jobs that go along with it, so we also see in many countries jobless growth, but when we have economic transformation, which brings with it the private sector, the dynamism, the growth, diversification of the economies, that also provides the potential for the fiscal space to devote resources to basic education, health, and so on, which are really critical. Right now, much of the public spending is going to either to public sector services, which are not great, and also a lot of it goes to infrastructure. So the more these countries are able to have economic transformation, structural reforms, reduce the role of state, and bring in the private sector, the more that will give room in the fiscal space to be able to have basic services for people. And that is becoming the biggest challenge right now, because many times these structural reforms are difficult. You have seen Argentina in the news. It comes with political economy of reforms. Many times when there is fiscal consolidation, if you're a highly indebted country, that takes time to transform and bring in the private sector. And therefore, there's always a tension between reforming and seeing the results of those reforms and being able to prolong and continue with the reform process. Technology and climate, and I'll end with those two big issues as well. Technology brings a lot of opportunities. You see in some of the countries where access to digital finance, access to markets, bringing down the cost of information and therefore the services has been really a big game changer. But it also brings out a lot of questions, you know, in terms of data privacy, data protection, large companies having power in terms of market power, and how that will shape going forward are issues that perhaps we can discuss later. But it also brings opportunities for transparency. And we had our President Malpass talk about what he termed frozen capital, which is there are trillions of dollars sitting in zero or negative yielding bonds. And that would be great to be able to channel some of that. Even 1% of that would be great for some of the emerging market countries. But that's not happening precisely because of the opaqueness and governance issues, as well as a lot of structural issues in many of the countries, and that's where the World Bank and other partners, other multilateral development banks come to, and donors, bilateral donors, have an important role in bringing transparency in terms of procurement practices, in terms of competition, in terms of public services. And I do think there's a role potential role for technology, if we can manage the risks in terms of bringing much more efficient and I will underline again the word transparency in terms of public service delivery. So looking forward to the discussion.
Thanks, Ceyla. Alexis from PwC.
Thank you so much. It's an honor to be with you all today, and really in honor of Pete Peterson's legacy. I'm very humbled to be contributing, or especially with two women. On the subject of fiscal responsibility, I think it's important to kind of look at the phenomenon of populism and emerging markets in advanced economies today. And really, we can trace this incidence and this creation of this phenomenon to the date of the 23rd of June, 2016, the referendum in the UK. And I say this because although we have had protectionism in the past, populism in the past, as Robyn was highlighting, the fact that it plays out in global markets today is what is so destabilizing to the rest of business, to potentially to even looking at debt servicing costs for economies, et cetera. And so there's some unique features that I want to talk about, but really the first one, even just looking geographically at the trajectory of this. So we had the referendum in the UK, we then had the Trump campaign and then Trump victory in the United States. We had another referendum in Italy, according to which then Renzi really stood up to his promise to stand down from government, which made way for an unhappy compromise and coalition with the Five Star and the Lega. So one very far right-wing, one very far populist new party. We've also seen the movement of les Gilets jaunes rocking markets in France, really still having an etiolating effect on household consumption and spending in France. And then we've seen sort of other waves of this popping up, which we'll come to a little bit on India and the central bank. But some damaging parts to this is the fact that we've had what is, I think, a trigger of income inequality, fundamentally igniting a lot of these revolutions. But it is far easier to point the blame at the wealth creation of another country for one's problems than deal with them domestically at home. And so therefore, the xenophobic protectionist piece emerges, I think, first and foremost as a rallying point. But we still have the underlying conditions which have contributed to vast income inequality in countries like the United States, like the United Kingdom, like Italy, like France. What is interesting to note is that in these economies, particularly the UK, the US, and Italy, these are the three OECD economies with the lowest intergenerational mobility of any other OECD. And what does that mean? It means that if you were born in the bottom two quintiles of the income distribution in the United States today, it is highly unlikely that you would ever make it to the top two. And I was very dismayed when I found this because I actually immigrated from the UK back to the United States for the American dream. And what is interesting is that one of the reasons for this is the educational premium that we have on the white-collar services jobs, which are actually facilitating a lot of the capital holder or rentier behavior that's happening. Other contributing factors, one of them being the globalization of labor markets, but just one of them leading to this. So yes, you do have import competition coming in from China and the United States at the very same time, simultaneously, as US manufacturing companies were investing in high productivity in the manufacturing sector, which led to skill replacement by machines. So this really playing out, really, I would say, since the 1970s and the 1980s. So this trajectory long underway. But of course, addressing some of these issues, which I'm happy to come to in the Q&A, takes far longer than our electoral cycle, which I would posit is about 2 years, because you're fundraising the other two. And another unhappy emergence of this phenomenon of emerging market behavior in advanced economies is what is not conservative, which is a rapid expansion of the fiscal deficit. And I was laughing with a Bloomberg reporter when we had the return of volatility to the markets in the first week of February 2018, which was effectively bond vigilantism. And I said, look, this is investors voting with their feet on the credibility of the United States and its debt and the ability, it's very real possibility that the US can default. It has defaulted before. And she said, Alexis, this rapid expansion of the fiscal deficit, I was speaking with a conservative economist earlier, and he thinks this is going to be great for the economy. And I said, since when is that conservative, rapidly expanding the fiscal deficit? It's not. But it is very much part of this populist movement that we're seeing. And when Di Maio calls for a Trump-style revolution in Italy, this is very clear. So in the United States, we're not setting necessarily a great example. When does it all come to an end? When do we start to feel the pain? I work with pension funds around the world, and I've had open questions as to whether or not people will stop buying the US Treasuries and running into the US Treasuries as a safe haven of investment. We're not quite at the negative yield situation where Germany is. That will not happen. So the US can afford to play this game, as Robyn was highlighting, because the US 10-year is highly desirable. And it was interesting to note that where we've had the most uncertainty in trade and a lot of the Twitter statements coming out, a lot of the tariff announcements coming out and being implemented and enacted, people are running into the US 10-year and pushing up the value of the dollar, which is interesting because that any emerging market investor would tell you the opposite happens. People flow out of the bonds and then obviously the currency plunges. So we can afford to, I think, for the moment, keep this going because people will still buy the debt. However, the issue is that we are crowding out very valuable spending. So if we think about the need, remember the infrastructure bill? We haven't heard about that for a while. We talked about BRI in the previous panel. LaGuardia, I'm very happy, is on its way to a new birth. Or a born-again situation. However, the infrastructure situation in America is very dire. And by infra, I don't just mean ports, bridges, roads. I mean social infrastructure in terms of healthcare and education. So infrastructure investors will tell you that within the asset class of infra itself, they would also include education and healthcare as part of this, as we've also heard as part of the World Bank's initiative as well. So we are crowding out the investment spending in the United States by our rapid expansion of the fiscal deficit. The Congressional Budget Office has just put out their recent report that our fiscal deficit will be at $960 billion this year, which is a $150 billion over the mark that the CBO originally forecasted. $150 billion is not a rounding error, ladies and gentlemen. Why this is, I think, why we've missed the mark is because this administration said that, and I was with members of the administration when they read these figures out on the index cards from their breast pocket, that this was going to be paid for by dynamic scoring. Dynamic scoring is a fancy way of saying that the economy is going to be so robust that we're going to have a lot of tax revenue from companies to be able to support this expansion of spending. But here's where the trade piece comes in. John Maynard Keynes and Hyman Minsky, after him, two late economists, said that in order to have a positive outlook on the future, in order to invest, you need to have a positive outlook on the future. And that's the same for households as it is for companies. So Robyn highlighted this issue on the global value chains and supply chains, where we really haven't seen the impact come up yet. We've seen the upside for Vietnam, Bangladesh, but we haven't really seen it play out on the downside. But the other issue is capital investment. So European companies, as a percentage of GDP, actually outpaced their American counterparts in the amount that they were spending in their skills, their technology, and their people. And that is a salve for the income inequality that we face and the decline of the purchasing power of the average European households. Because when you're investing in your skills and your technology and your people, you're actually able to increase wages over the longer term. However, the fact that 44% of Eurozone growth comes from trade means that we, with our trade policies, are shooting the Europeans in the jugular vein of their economic growth. And so now, having outpaced the United States in their capital spending, all of its capital spending has taken a nosedive, and I would posit also that the trade war begins third week of March 2018, more or less. And so these have longer term repercussions, which I think are highly significant. And I do want to just come across to India. I know we have the next panel on India, but just from a global macroeconomic outlook, to be able to say that whereas in the United States, I think that the biggest issue with our debt is our debt servicing costs crowding out. In Italy, I think probably the biggest issue with the debt is the fact that it has a very rocky relationship with Brussels, and that it may have forgotten the fact that global markets finance this debt, and global markets may not want to be able to support this debt, as we've seen with the shedding of foreign investors holding Italian government bonds, is the prospect of inflation. And in India, the prospect is real. So when you have a run-up in debt and you effectively start contributing to M1, which is money supply, and putting more money out with potentially less productivity to be able to service and to be able to buy, you potentially have a run-up in inflation. And so I have been very concerned watching since November 2018 the loss of central banking independence in India today. And where I think this is very concerning, and we've seen a lot of changeover and turnover in terms of governors in the RBI and deputy governors, is the fact that with a very young population, you could see a run-up in inflation, and we haven't hit this yet. So I'm very, very concerned about this. There is, of course, a correlation when we think about headline inflation to the oil price shocks. And we think about the extent to which India is really replacing China in terms of global oil consumption. If you have some continued and sustained shock to supply, this is potentially worrisome. And so I would just highlight that. I think that, again, I'll draw it back to the United States by saying I don't think we're setting a very good example for the world in terms of just sort of flagrantly forgetting the fiscal deficit. So with that, I'll stop.
Great points, and we're going to be watching the price of onions in India to see about the inflation question that you raised.
Tomatoes.
And tomatoes. And I want to come back to you in a minute to talk about Brexit. But first, as we've been talking about uncertainty, I want to ask you, Ceyla, to address the sort of like most basic uncertainty, which is weather. Climate change, just past a week past Climate Week here. The World Bank, I know, has a lot of initiatives designed to help developing countries in particular get through the unexpected cost of more frequent and larger storms. Can you tell us about what's in your toolbox now that we might not know?
So this is, of course, a key priority area for us, and it links very much to the issue of fiscal as well. There are countries which, due to extreme weather implications, have to spend 50% of their GDP in dealing with the costs of these events. In Kenya, it's 12% just because of droughts. In Jamaica, because of so the costs can be very large. Indonesia is another country which faces these contingent claims. So what we have been working on are in terms of so of course mitigation, but also adaptation. And the first, of course, is to be prepared. So we are working very closely with our colleagues at the IMF as well in terms of budget projections and making sure that there is some contingency planning for potential extreme weather events, especially in countries which are much more volatile and subject to these shocks. So one is preparedness, working with countries in terms of putting aside budget and also much more resilient infrastructure, which can help bring the costs down. So that's second, resilient infrastructure. Third, of course, is financial instruments which can help risk transfer. So that's anything from CAT bonds, catastrophe bonds, to risk pools for certain regions, and even some specific country-level insurance mechanisms to help deal with such costs. And I'll mention one of them because I think it's really links also to technology. Is a program we have actually in Kenya, and it's called the Kenya Livestock Insurance Program, CLIP. And it's what it does is basically use of insurance in a different way than we usually think about it. Usually we think of insurance as coming in and supporting or paying for losses after the event. What this does is using geospatial information, it measures the grazing conditions, and therefore a month before the drought comes and all the livestock are dead, it allows the pastoralists to have access, automatic access, when that the rate is range is hit, so that they can either buy feed in advance or move their cattle. And that has been quite transformational. And we are looking at other potential avenues for scaling up these type of mechanisms, using also collaborating with our sister institution IFC, working with the private sector and so on. So there are different aspects in terms of larger catastrophe bonds to more what I could call micro programs, which look at specific country circumstances to deal with these potentially devastating, both socially and financially, extreme weather events.
This is really interesting. You're ensuring, cow grazing, What about green bonds? Is that something that you guys, can you tell me more about?
So we have, with our treasury, we have programs. We had the first, in many countries, first green bonds, first green sukuk in some of the, in Malaysia, and we have been working with Philippines as well. So that's another area of work, looking at what are the standards and principles that can be used to allow for development of what are called green financial instruments. Also working very closely with the private sector, with investors, especially institutional investors, which are looking for ways to make returns, to see if there are opportunities for introducing and increasing environmental and social safeguards, so that investments can go to companies and governments which are taking steps to quote-unquote green their either their countries or their companies' investments and production.
Can I ask you to take a quick stab at Brexit? Because there's so much uncertainty about it. Whatever you say may be, surpassed by news in a week. Oh, sorry? No. Okay.
I'm not wearing black today, but I would be in mourning for my adopted country of the UK. In all humility, we've never been here before, so apropos Robyn's point, we have no idea what will happen. With the United States, we have either 1 year or 5 years of Trump, so we kind of can see that. But in the UK, we really have no idea what will happen. Trouble of having a country without a constitution is very hard to get to constitutional crisis and to figure out what is constitutional. And so in the UK, I think what we have, I will stick to some of the facts that we see with Brexit, which of course, this is a very clear pronouncement of income inequality, people feeling at the blue collar end of the spectrum that their purchasing power has been declining due to an influx of foreign workers and cheaper labor. At the white collar end as well, which Trump also has the support, is there is this, I would say, this sort of exceptionalist place, which is an anti-global stance. So we just heard the quote on globalism. We see the same thing in Brazil with supporters of Bolsonaro on the right wing. Macroeconomically, which is where I spend a lot of my time in the UK, the numbers look fairly dire. You had some, I would say, some either ostriches in the sand, sort of people lurking their heads, not really wanting to see some of the data and the hard facts. We now in the UK have a negative household savings rate, which is lower than it was during the crisis. So when you think about the fact that consumption has really been driving this economic expansion since Lehman, that ability for households to continue the expansion in the UK is negligible at best. Also, when I think about some of my credit card company clients, they're posting record profits in the UK because some of my friends are having to put their tomatoes on credit cards. So it's a pretty dire situation. If you think about the drivers of economic growth in terms of industry, this is 100%. The 1990s brought in all of the FDI flows into the City of London. So it is 100% financial services. And if you divide financial services into three buckets, investment banking, insurance, and asset management, only one has survived in the UK, which is asset management. Because asset managers don't necessarily need a derivatives trading desk, a clearing desk, a currency desk to be able to continue their operations in a way that the investment banking piece needs, and again, sometimes the insurance piece needs. So financial services sort of gone, effectively. It is a post-industrial country where between 80 to 90% of employment is services oriented. And if you think about the future of services also in the UK in terms of the technology, we talked about technology and the growth of Shoreditch, you really need a positive immigration policy to be able to support these highly creative jobs. When I go out to some of the Silicon Valley companies, there are continuously an influx of young East Asian, South Asian PhDs coming here to do, they're working on AI and they're doing their stages at these companies. And in the UK, you actually need that to be able to sustain economic growth. So with that, I would say that even Theresa May's plan, which was by any means probably slightly moderate, the Confederation of British Industry has stated very clearly that this is not an immigration policy that supports economic growth in the UK.
Right.
So I'm worried about that. And then just this one other prospect, again, tying us back to the fiscal responsibility piece, is I'm kind of more concerned at this point about a Jeremy Corbyn government, which probably was unlikely if you did not have a referendum. And when you total up the promises of spending that the proposed Corbyn government would spend, that money's going to have to come from somewhere. And it would probably likely come from companies more than households in a Corbyn government. So I think, again, the knocks to business and economic growth are really, really severe, no matter what happens with regard to the relationship between London and Brussels.
Lest we get as depressing as earlier panels about the challenges the global economy is facing, I want to go to audience questions, if I may. Sir.
So I need to just kind of preface this in order to tie it in with the topic of the fiscal responsibility. So the 2007-09 financial crisis was a disorderly deleveraging process. And in response, the governments around the world said that they needed to do two things. Sequence mattered. Restore the health of banks and the flow of credit, followed up with fiscal austerity. Global debt grew from 150 trillion to 230 trillion, in part because China borrowed very heavily, restored growth. Appetite for fiscal austerity went away. Then China announced its Made in China 2025 plan, where they're going to subsidize the strategically important industries. They need to break out of the middle income trap. Here in the United States, we have no appetite for fiscal austerity. Our answer is also GDP growth. These subsidies that China is introducing in a book called Subsidies to Chinese Industry by Usha and George Haley, and note that I give her name first, they indicate that when you have these capital-intensive industries, if you subsidize these industries, once those industries are sewn up, no company, no foreign competitor guided by natural market forces is going to allocate capital to those industries because it's too late. So time is of the essence. So what alternative is there to tariffs if you need to stop these subsidies ASAP? The TPP, it may have had all sorts of other merits, but that's a very long-term kind of a strategy to get China to kind of come into the fold. What alternative is there to these tariffs? They're costly, but these subsidies were costing us hundreds of billions of dollars a year.
Alexis, you want to talk about that?
Tax incentives to grow innovation in the United States beyond an app to order a pizza delivery better. I mean, so really, I think if we think about tax breaks versus incentives, and we think about the environmental piece, for example, people talk about the carbon tax. But what if you were able to actually give an incentive to a company to look to the fifth fuel, which is energy efficiency and making things more efficient? And we've done that. We've done that in our motor vehicles in the United States, et cetera. So I'm thinking more on how do you actually use fiscal policy to stimulate more innovation for private sector companies to take on more of the responsibility themselves. Germany is the greatest example of where that educational component and a vocational piece is built into the company. in the German Mittelstand. I think we could do that in the United States. Amazon's recent announcement is one where, said we're going to retrain our workforce. So where are we being creative about supporting that? The Chinese piece on what is interesting is I've watched their fiscal policy and their stimulus measures since the trade war has hit. And by all means, when you look at the data with cold, hard eyeglass, they have been very abstemious in their response. It is not the old style injections of infrastructure spending to be able to spur growth in ghost towns, etc. What the Chinese have creatively done is to toggle, and this was already underway really since '05 when consumption started replacing net exports as a percentage of GDP in China, significantly. But they've been able to toggle employment to be able to support services and consumption and light, tight electronic manufacturing. So when there were a number of tax announcements made, the government, what Beijing actually did was stimulate activity in private sector companies by giving them a tax break in specific sectors. So that's something I think that's a positive measure. And maybe we could think more creatively about how to do that and think about the sectors of growth in the United States going forward.
I know we're running out of time, but I want to take a few audience questions, and let me go to this table. Let's take questions first, 1, 2, and 3, and after I hear all your questions, then we'll answer them.
Okay, so with the current agenda of our country's current administration pertaining to protectionism, companies have been forced to readjust their supply chains away from the U.S. With this in mind, what are some of the ways to reattract these companies back to the U.S. to reorganize their supply chains, and if possible, and with what incentives?
Right, second question? Yes, young man? Younger than me, anyway.
Hi. So my question is, with the recent Howdy Modi event in Houston, Texas, and with heightened relations between Trump and PM Modi, do you see the U.S. indirectly showing China that they have a new rising economic ally with relatively same population size as them, along with the same geographic location? And furthermore, do you think that the U.S. would give them a duty-free export, which is precedented by the AGOA Treaty and with countries such as Honduras, Jordan, and Israel?
And up here?
Yeah, looking specifically at the China trade tariff issue, Trump is obviously listening to Lighthizer and his other observers who claim that China is getting hit roughly 3 to 3.5 times more than we are, bottom line, by the issue. Do you agree with that figure? Is it a reasonable estimate, and doesn't it indicate that this whole thing is more intractable than even you would have proposed?
Okay, I'm going to take the India part of the India question now on the Howdy Modi campaign, which the gentleman refers to. India's prime minister came to Texas. There was a large rally Trump attended, and your question was, is the U.S. showing favoritism to India as a way to counter China? Is that a new approach of the United States? And I would say that has been the approach of the United States for quite some time. India, historically non-aligned country, has not shown favoritism to the U.S. or China, but has tried to play, or Russia has tried to play everyone with it. But the U.S., this approach is not new. The U.S. has tried to balance, used India's ties to balance things, both economic and even military as well. But let me let others speak to the other questions on China and the rest.
Happy to speak on the China one. I think if we look at the impact, and again, I would highlight there is the European dimension as well, which we forget by the wayside. But if we just look at the U.S. and China and the impact on China, I would divide this into 3 segments. The first would be tariffs, the second would be supply chain, and the third would be technology. And we've recently had some refreshing comments from the Beijing trade negotiators saying that we're going to try and focus on trade in the trade negotiations, which is, wonderful, probably helpful. But on the tariff piece, I think we're seeing the damage be done. But what's interesting is Beijing has been very resilient at being able to diversify their, completely diversify. So they are really replacing net exports to the US, and it's very stark with both Europe and ASEAN countries. So that's fine. The second piece on supply chains is slightly concerning. Again, I don't think we've seen this come up in the data yet. Chinese MNCs are following their US counterparts to places like Vietnam, Vietnam being one of the largest destinations, Taiwan being another. The third piece is the darkest. I was in Beijing when the Huawei dimension came into, really started escalating, and it was a couple of really dark days for me, I can tell you. Because if you are, and it's a question mark as to how this pans out, if you have a bifurcated global technology system, that is very damaging to global growth. It's very damaging to Japanese companies, Korean companies, European companies, and even US companies. So that's where I would say that whatever the president wants to multiply the impact, that would be the worst outcome.
Ceyla, do you want to weigh in very quickly on value chains?
Just very quickly and put an advertisement. We're actually coming out, our World Development Report, which is just coming out now, is exactly on global value chains. It has a lot of analysis on where these how these chains operate, what it means. There's even a gender component because women tend to benefit from the global value chains in many of the emerging markets. But it does show the importance of innovation in really making sure that the global value chains remain successful. And many of the multinational companies are actually from the US, although they are moving operations outside of the US.
Excellent. Well, listen, with that, let me thank this excellent, excellent panel. Let everyone get to lunch. Thank you.